you've got the extended Sendero research team here, and it's noon hour on Wednesday, August the 7th, after we've observed a lot of volatility in the market. And this group has both on one-on-one basis and collectively been speaking with each other a lot over the last few days. And we sort of decided that we wanted to share our process with the rest of you in terms of how we try and decipher what's been transpiring in the markets and how this may have impacted both what the risks and what the opportunities are like in the market. A lot of this has been driven by what people have been speaking of in terms of an unwind of a yen carry trade. And we know that that's a pretty vague concept for a lot of people. And so I'd like to turn to Patrick first and ask him, can you just sort of walk us through what we mean by a carry trade and what we mean in particular by the yen type carry trade?
Sure. Thanks, John. The first is when people say the term carry trade, carry is the term in financial markets just for the steady state earnings that you get from a position. And so generally what you do is you use leverage. People borrow money, and as long as they can find a source of leverage where the cost of that leverage is lower than whatever asset they're buying, then they earn money if nothing happens. And even better is if you can find an asset that not only earns more, but goes up in value. And even better, if you can find a liability, which is the thing you're borrowing to fund that trade, that can go down in value, it becomes a very profitable position. And so by their nature, though, because carry trades tend to be short volatility, because the attractiveness of them is that you get to make money if nothing happens. And the sort of size that you can do is related to the overall volatility of both the asset and the liability and their kind of relative volatility to each other or their correlation. And so if the volatility of either the asset or the liability starts to go up, and especially if it's downside volatility in the asset or the liability on the liability, I mean, the volatility on the liability goes up where it rallies, either of those things can trigger someone to have to reduce the entire position. And so effectively they're short volatility, but where it gets more dramatic is the very act of reducing those positions, so selling some of the assets or buying back some of the liabilities, can exacerbate the very volatility that they're trying to avoid. And so it becomes self-reinforcing. Higher volatility begets higher volatility until people have repositioned and gotten, their balance sheets down into a sustainable level. So how this relates to Japan is Japan has had zero rates for decades. So it's always, over that period of time, it's been a very attractive source of the leverage of the borrowing side of any carry trade. You can borrow at zero, and then you can own, even if you own US Treasuries, you earn, somewhere between 3.5% and 5%. But various US assets, even US equities, yield more than the Japanese yen. And so it's been a very attractive asset to fund really any as a very attractive liability to fund really any asset globally. And the thing is, as these trades work, they draw in momentum players, other players who are, they just go to whatever's working. And the very fact that the trades are working brings in more participation, so they become very crowded. And most risk systems use volatility as a way to determine how much you can hold. So the lower the volatility in these trades goes, the more people are going to hold in them. If you just sort of take a schematic and think of, there's a whole lot of people who have been borrowing yen and buying assets all over the world. Well, the Japanese government has gotten concerned because their currency had gotten very weak. It was down probably over 50% in the last 12 to 18 months. It's actually down, it was about 30% in the last 12 to 18 months. So the numbers are, it got down to 80 a few years ago, It's now at 162. About a year and a half ago, it was somewhere around 120. So it's had a huge move in terms of its value. Um, and the Japanese got concerned about that. And so a combination of the Japanese Ministry of Finance and the Bank of Japan have acted to strengthen the yen. I think they were concerned about inflation and even a full-blown currency crisis if the currency kept getting weaker. And the stronger yen, remember, the yen is the liability side of all of these carry trades. So people, they're short yen. If you're borrowing yen, you've got to still pay them back. And if the yen's value goes up, you have to pay back something that costs more. And so when the yen started to rally, it forced people to take these trades off. And the fact that they're taking these trades off forces more people to take them off. The volatility feeds on itself. And we've seen that over the last few weeks, but I would say that the initial episode of the yen, obviously anything can happen. I'm not privy to what the Bank of Japan or the Ministry of Finance are going to do, but they have made announcements that they are no longer trying to weaken the yen, nor are they going to, in the short term, try to make the moves to raise interest rates, which was one of the triggers of this. They're kind of going to hold off and make sure markets can absorb it. So that does mean that this initial trigger from the yen is likely run its course. The bigger question is whether the volatility that we've seen up to now can possibly have knock-on effects across other markets, as volatility tends to, markets are global, balance sheets are connected globally. So people that own assets across a lot of different asset classes, the volatility in one area can start to feed into volatility on others. So that's where we are now. I'd say the short-term yen-driven liquidation appears to be getting a reprieve, but the question of whether this leads to like a longer term, more systemic issue remains to be seen. But it's certainly the risks have fallen in the last few days as the yen has stabilized.
I think the important thing there to sort of take away is that, that increase in volatility becomes the transmission mechanism by which other assets around the world will react. And we've seen a lot of that. Things certainly look like they've stabilized by this point, 48 hours after we all had a very nervous morning starting at 3 o'clock in the morning, watching what was going on in the markets. So that was a challenging experience. Thano, you've been looking at this, and you also, I think one of the things you really picked out that was interesting is you looked sort of at where the yen peaked from a timing perspective and when the equity markets peaked as well, too.
Yeah, thanks, John. The yen peaked, or the dollar versus the yen peaked on July 10th, which was the exact day of the peak of the NASDAQ. How big of a deal can Japan be for the U.S., just to put some broad numbers on it? The size of the total debt and equity markets, just broadly speaking, is about 80 trillion in the U.S., 40 trillion in China, 30 in the EU, but 20 trillion in Japan. So fourth largest, but still a significant number. One of the questions about how much has this run its course is, how big was the trade? It appears that maybe 75% of this has been unwound, but nobody knows for certain. When I think about systemic risk sort of bleeding into other areas, the first thing I like to look at is high yield credit spreads. And those have moved up on Friday and Monday about 60 basis points, putting it about 380 to 400 basis points over treasuries. That's not that bad. I mean, that's kind of where it was at the beginning of the year. So far, it doesn't seem to have bled into the U.S. debt markets, which is always a concern of a more systemic risk. So, we are not as close to the Bank of Japan in terms of what their thinking are. But I think that they acted fairly quickly with some comments from the deputy minister yesterday to calm the market. And so far, the Fed really hasn't even weighed in. They have a lot of arrows in their quiver that they could do. They could reduce or eliminate quantitative tightening. And they could also, of course, speak to whatever their plans are for lowering the Fed funds rate. So
I think that last point is a good point to make. There are a lot of quivers that the Federal Reserve has to stabilize financial systems if they need to. Clearly, they made the evaluation they didn't need to. We heard a lot of people Monday morning banging the table saying the Fed should be doing an emergency cut. Reality is that probably would have exacerbated the situation of the interest rate differentials between Japan and the US
Oh.
in in in, in some ways. Um, but that wasn't necessarily something that we really needed to see happen. And I think the fact that the Fed has sort of been very quiet, in the next 2 weeks, we're going to have lots of opportunity to hear them speak about what's transpiring and whether they will be lowering rates when we get into September or not. I think it's most reassuring that they didn't have to step in any way to stabilize markets. And they only really have to do that when you can't find buyers and sellers that can create an equilibrium. And it certainly appears that we've found those equilibriums in the market since. So that's a very positive development, I think.
Yeah, and John, I would just add that the Fed is not interested in stepping in if the market is blowing off some steam from a little bubble that we may have had in the NASDAQ or other stocks. They have no interest in that whatsoever. But if this were to become systemic in other areas, which is why I look at the high yield spreads, they would be sort of concerned about that. So I think there were a lot of actors that were chasing returns and they're using the yen to do it. And when it went against them, they were forced to unwind those trades. And what we saw in the last week is what happens.
That's a really important point I want to emphasize. We sort of blame people almost want to sort of blame this on the Japanese institutions. It's not necessarily. I think what Patrick pointed out in terms of, leverage players will use wherever the funding is cheapest, and the cheapest was Japan. It's not necessarily Japanese players that were causing this to happen. It's quite simply what were they using as a funding source, and when that shifted, that changed a lot of the dynamics here from that standpoint. And the other point I think to make is, from top to bottom, the S&P corrected by what, 8%? That's not even considered a correction. We have those multiple times per year. So, the reality is yes, the NASDAQ, the very tech centric and the sort of Magnificent Seven centric stocks where the most momentum has been was more negatively impacted. But by and large, the equity market was able to absorb this pretty quickly.
Yeah, just to that point, John, just to put some numbers behind it, 5% pullbacks, on the S&P 500 since 1928 happened about 3 times a year. A correction, which is 10%, happens about once a year. And again, as of today, August 7th, the drawdown that we saw in the S&P from close to close was only down 8.5%. And as of today, we're closer to down 6. So again, what we do with Ricardo and Rodrigo on the rest of the team is look at what are managers doing? Are they reallocating? Are they rotating into new names? But more importantly, we're looking also just kind of where cash levels are with portfolios. Obviously, we have diversified portfolios, and that is just another great reminder as to why we do so why we have a fixed income allocation, and also some of the diversifiers to Daniel's points on the credit side.
Yeah, that's an excellent point. And we can watch real time what's happening within individual managers' portfolios as well too. And so we were able to monitor all of that. We had a lot of discussion going back and forth. And it's really why we felt we didn't need to say anything on Monday. We're better to wait and see how this all unfolded. So I hope this has helped give everybody a bit of an insight in terms of how we approach and how we think about the research process and the macro investment environment from that standpoint. And if you have any questions, please don't hesitate contacting us.